Rock Capital Management webinar, and it's great to have all of you listening in and watching too. This is exciting for us. We want to talk today about our a couple of things. One, certainly want to talk about why Paul and I have decided to work together to create the private client division of HighRock. I want to address that. We'll do that first, and then we'll talk a little bit about markets and a little bit about our thoughts as with what we see going on and how we're going to be looking at the markets and in conjunction with client portfolios as we go forward. So let me start by saying that when Paul and I first sort of sat down together to talk about what we wanted to do, our challenge to ourselves was to create an offering for clients that was something that was different and better than what other investment advice channels were offering. And you know, it's not easy. It's a very competitive world, but we found a few really key points that we wanted to highlight and allow ourselves to move into what we would classify as a top-tier advice firm. So let's talk just a little bit about HighRock and HighRock's history. Paul founded the firm in 2010 as a management firm advising for Scotiabank on 4 of its funds and was able to build it into a $200 million company. And on as a progression, what we want to do now is start this private client division so that not only can we manage our money, but other people's money who want to join with us to experience what it is that we want to do for ourselves and for our private clients. Let's talk a little bit about who we are. Paul has been around a long time. We worked together many years ago at Merrill Lynch as bond traders. You all know pretty much what I've been doing, but certainly after his days at Merrill Lynch, Paul became a portfolio manager at Hesperian Capital, and after running a couple of successful funds there, moved on to start HighRock. So lots of experience working from that perspective. Bianca Tomlinson, our financial planner and our associate, recently was able to get her certified financial planner designation. Brings lots of quality planning to the table as well. So really rounding out a good team here. Okay, so let's talk to those things that Paul and I felt were the really important things that we were going to be offering our private clients that we feel are at a higher level than most other financial advice out there. And one of those is that we wanted to hold ourselves accountable at a higher level. And that's where the whole standard of fiduciary duty comes into play. We want to make sure that we have our clients' interests first and foremost. And we have to put our clients' interests ahead of our own as part of this fiduciary responsibility that we're obligated towards. A second step, and above anything that anybody else does, is that we have hired an independent review committee that will monitor us to make sure that we're doing all the things that we say we're going to be doing. We do this because we want our clients to have complete transparency over what we're doing, and that an independent review committee can provide that to say, yes, they're doing what they're supposed to be doing, they're doing what they say they're doing. We think that's really important. Something else that we think obviously is very important is that we don't want to be responsible to anybody else other than our clients. So we're not going to get paid by anybody but our clients, and that's really, really important. So that independence is something that we think is going to be very, very crucial, and it's something, again, that holds us apart from the herd. All we do is with the best interests of our clients. We will sit down, create an investment policy statement. I'll talk a little bit more about that in the presentation. But from that investment policy statement, it is what gives us the direction to move forward and to help our clients and manage their money. Most importantly, it is a private firm, so we have no internal or external conflicts. And one of the conflicts that Paul and I often discuss is that in a big company, often an advisor is held to a specific revenue target. We don't have any targets of that nature. We don't have anything that we're trying to have to live up to from a financial perspective on our own, for our own benefit. So I think that is another thing that's really quite important. One of the things that has always been a standard that I want to make sure we're living up to, and that's looking after our clients, to make sure that we're giving you the attention that you need and to know you well and know what you need to manage your money. And to both of us, I think that's really important. The great thing is that we, Paul and I, are portfolio managers who are actually managing your money. It's not being farmed out to any third parties. I think that in and of itself is important, and we'll talk a little bit more about that in a couple of minutes. Our experience, lots of years under our belts. We started and got our education in the bond markets. I'll talk a little bit about what bond markets mean to the rest of the capital markets in a sec, but we also have attained the highest levels of our of designation in the financial industry. So Paul's a chartered financial analyst. I'm a chartered investment manager. Bianca's a certified financial planner. So we're at the top of our education, and all of these things give us the ability to continue to look after our clients with all of these with all this education. So let's talk a little bit about what it means to us and to our clients, because our background is immersed in fixed income. Fixed income markets, bond markets, are really the markets that lead financial markets on a global scale. We know what's going on inside the bond market. It is the key to what is going on basically in the global economy and other financial markets. So that in and of itself is something that differentiates us from other advisors who are more stock market oriented. We know that and take our lead from things that are going on in the bond markets. They're going to trickle into the stock markets eventually. We want to be ahead of the curve when that happens. As I said before, Scotiabank has given us confidence to entrust us with $200 million in fixed income funds. That obviously means something, and to them, and hopefully that gives some confidence to you as our clients. Another really important facet of this business, especially because we're entering into what we think is an era of lower returns. We've had some pretty decent returns over the last few years, high single digits, low double digits. We could be entering into an era of reduced returns as we move forward in time. And when that happens, what's really important is to try to keep the cost to our clients down so we can maximize the returns that we are getting. And that, to us, is extremely important. Our ability to be an institutional money manager gives us the wholesale pricing for building portfolios. Well, we want to use that wholesale pricing and be able to pass that on to our client base. Now, just as an example, many of you have owned or own Advantage High Yield or High Rock High Yield funds that Paul has been managing prior to our arrangement. Those funds are, we purchase those to get the expertise that somebody like Paul brings to a portfolio, but there is a fee attached to that. And that fee is something that we can now eliminate. And that, to us, is a great solution for having or reducing costs for our clients. As I always have in the past and constantly remind people, we want to take a balanced approach. I've always taken a balanced approach. That's nothing new. We believe that you have to have a combination of fixed income assets and growth assets to manage all the risk and volatility, and we expect that risk and volatility to probably rise in time as some of the returns come down. So again, being balanced, being diversified is really going to be a key to continuing to get decent returns into the future and not be exposed to, overly exposed to any risk. One of the things that we're going to really focus on are our models, not dissimilar to models that I've run before, but in this case, we are not going to be using anywhere near as many ETFs as we have been in the past in my models. We are going to buy all our fixed income in-house, again, using that ability to reduce costs. Again, as we all know, fixed income helps to bring volatility down and provide income streams, and that's great to have in a portfolio. Global equity will be a broad, diverse base of ETFs, low-cost ETFs, basically to get the diversification and balance on a global scale that also will allow us to keep volatility low in the portfolio. And then in the past, where we've owned some specialty situations, we've called them alternative to a degree because they're outside of the range. They're not really, this is not really alternative in the true sense, but they are going to be managed in-house. So where we've had Barometer in the past to add a more tactical approach to asset allocation, we're going to do that in-house. We think that we have a great history with some monitoring and managing small and mid-cap company portfolios. So we want to have this ability to provide opportunity. I'll talk a little bit more about how we balance this all out for you as our clients. But again, it's just we think this is an area that can provide great risk-adjusted returns. If that's value we can add to your portfolio, then that's certainly something we're going to make an effort to do. So for new clients, the process is to get together, understand what your goals and objectives are, understand how that all fits, create a plan, and use that plan to determine what it is that we need to do for you from an investing perspective. In the beginning, we'll have this discovery meeting. We discover each other in a sense. We learn that whether or not we feel comfortable working with each other. If we do, we move forward. We open accounts. Your accounts are going to be held at Raymond James. Raymond James Custodial Services is our back office. What's important here, and I'll talk a little bit about this more down the road, but is that all of your assets are held at Raymond James. So we don't have any control. We don't have the ability to move money in and out of your accounts unless you give us permission or to do the trades. We can't do the trades that we need to do until you give us permission to do so. So in the process, of course, as I said, we'll create a plan. The wealth forecast will tell us what it is we need to be doing with your portfolio in order to meet your goals. So we'll come up with an investment policy statement that identifies exactly how we're going to do that, what the parameters are, what the asset allocations will be, all in keeping with the risk that is acceptable. for you, our clients. We will have an investment management agreement that you approve and sign off on based on, of course, the model that we design and build for you. And then once that model is designed, we implement the portfolio, and in time we will have reviews in order to keep you up to date. Not only to review the portfolio, but also to review your situation in life, to make sure that what we're doing is still in keeping with the wealth forecast, to make sure that any adjustments or changes are being monitored and appropriately looked after. So let's talk about fees, because Paul and I, one of the things that we really believe is important is transparency of the costs. And as I said before, we want to keep your costs as low as we possibly can. So our fees, our breakdown in fees is that we have a management fee, and then for some of the exchange-traded funds that we'll own, there are some management-related fees. Management expense ratio, on average, will be just a little under 10 basis points, or 1/10 of a percent. And together, combined, the total costs will be in the vicinity of just a little under 1.25%. Now, interestingly enough, for clients who've come over from Turner Tomlinson, our management fee in the past may have been around 1%, but the embedded costs of ETFs and other funds like HHY or Barometer added approximately 40 to 50 basis points, so almost 0.5%. So yes, the fee may look a little higher. However, that fee includes the custodial fees at Raymond James, as well as, we will actually be significantly reducing the costs of having external managers looking after some of the money. One of the things that has always been a very important factor for me is communication. We want to make sure that we're continuing to let you know what our thoughts are with regards to markets, with regards to wealth management in general, with regards to the global economy. So I will continue to write a daily blog. I started at the beginning of January. I'll continue to do that, and I welcome anybody to ask questions or comment at any time. Very important to stay in touch that way. We will do these weekly webinars. If you can't make the 4:15 call, we'll certainly be able to. We are recording this, and it will be available to you. So we'll be looking after that as well. We will definitely be sending out quarterly updates, portfolio updates, and then, of course, as I said before, we'll continue to badger you for a semi-annual review. However, if you want to have a review at a more frequent pace, we're absolutely happy to do that as well. Very important that you always feel comfortable and free to give us a call. Let us know if you have any specific questions. We're always available to talk 24/7. You've got our emails, you've got our phone numbers, all our contact information. Anytime, just get in touch with us. We want to talk to you. And that's what we think a happy retirement will look like. Lots of opportunities, lots of smiles on your faces, a comfortable lifestyle. I think that's everybody's goal. Our contact information, of course, if you don't have it, we're happy to give it out, and we'll follow that up shortly. Our wealth forecast, for those of you who have done them, understand how they work. For those of you who haven't, all we're trying to do is understand what your goals and objectives are, and try to be able to create a projection of how things are going to look. Now, of course, we make all sorts of assumptions, and all these things can change: inflation rates, tax rates, growth rates. Everything can change. It's very important that once we build this wealth forecast, we continue to monitor, update it on a regular basis so that we're always in touch with any changes going on in your life and making the appropriate adjustments to your portfolio if necessary. What the wealth forecast will do is help us to determine what your asset allocation mix should be. So how should we allocate the different models to your portfolio? As an example, in this case, percentage of fixed income, a percentage of equity, and perhaps a percentage of that percentage of equity divided up into the global equity ETF fund, or, model and the Canadian growth equity model. Okay, back to fees just a little bit, because this, we think, is an extremely important message. When we look at fees over a longer period of time, it is absolutely incredible what we see other investment advice channels offering relative to what we're doing. And as you can see in the right-hand side of this schedule, taken from a Vanguard survey published in the Globe and Mail late in 2014, but average advisor fees of about 1.25% before they add on the average mutual fund management expense ratios. When it all totals out, you can see the total all in at well over 2.5% relative to ours at around 1.25%. Again, we're basically cutting the average in half. How does that translate? Well, you can look at a portfolio over a period of time, 10 years, 20 years. The chart on the right really does explain it vividly, but absolutely significant as to how that impacts a portfolio over a longer period of time. Let's go back to that point that I was talking about earlier when we talked about fiduciary duty. And I think that we want to differentiate between what most advisors have to do and what we have to do. Most advisors have to provide a standard of care that is fair, honest, and done in good faith. But that falls far short of the actual obligation of a fiduciary responsibility. We have to act in your best interest. In fact, we have to put your interest before our own. So you know that we are always looking out for you. For whatever reason, your interests have to be put in front of ours. And I think that is absolutely imperative when it comes to being looked after properly. And that's what Paul and I want to do. So I'm going to just get back here a little bit to the Independent Review Committee. As I said before, it is intended to provide our clients with the comfort that we are doing what we say we're going to do. And that, to us, is really important. We want to be able to maintain and keep the trust, and if we have somebody from an outside position monitoring that, reporting back to our clients, we think that's going to be just fantastic for them. So that's what we are doing. We've brought in Witchcrest Compliance Services, Jonathan Heyman, and the one thing that you may see here, and I'll highlight, is that he was a former supervisor in the Ontario Securities Commission. I think that is the credibility that Jonathan has that will add significantly to his role as the Independent Review Committee. And so right now I'm actually going to bring Paul in and get him to just chime in on anything that he thinks that I may have left out or not focused on enough, and if there's anything that he wants to add to some of my comments.
That's great. Thanks very much, Scott. And number one, I'm thrilled to be partnering with Scott and working with both Scott and Bianca, and hopefully others as we grow. But I would just add, Scott, that we are now a more well-rounded asset management firm. We started for the first 4+ years of our life at High Rock as an institutional or a wholesale portfolio management company with, I'd say, a very, very serious focus on high-yield debt, which requires a lot, people may not know, but requires a lot of very bottom-up fundamental research, doing a lot of work on companies. So that was sort of our area of expertise. But what you see in front of you today has a ton of synergies for our private client division, because our contacts in the marketplace and our knowledge of the bond markets, both government bonds and through to high yield, enables us to manage more of that money in-house. And as Scott showed you, I think on slide 18, fees matter a lot, and that's super important. Very few people understand how the fee structure works in Canada, and it's all going to come to the forefront over the next year and a half with regulations being put in place by the Canadian Securities Administrator and driven by the Ontario Securities Commission. So I think that's really important. And the other key factor is that fiduciary duty. We're registered with the Ontario Securities Commission as a portfolio management company. The investment advisor channel, which we absolutely do not compare ourselves to, but nonetheless a competitor. They are registered with IROC, and the stringent nature of the OSC is much higher. Well, it is a fiduciary duty versus a standard of care. There is no comparison, as you saw. So anyway, we are very excited to get going and start developing our business. And thank you very much for your consideration. Thanks, Scott.
So that's chapter 1. I'm just going to quickly get into chapter 2 of what we want to talk about today, and that's a bit of what's happening in the markets. And Paul, we talk about this on an ongoing basis, but certainly something that we're concerned about and is giving us a little bit of caution about how we invest, especially invest new money that's coming in at this juncture. Everything's looking awfully expensive. Here's a chart of the S&P 500 and in white, and you can see how earnings have performed over the last little while. And while earnings growth has gradually been rising, obviously the S&P 500 has been rising at a faster clip. Back in 2011, there was some excellent value to be had by owning the S&P 500. Even as back in 2013, there was still value. But as we got into 2014, and the gap between earnings growth and the S&P 500 price activity started to narrow, value started to leave the S&P 500. Most recently, right now, we're looking at earnings, significant deterioration in earnings, and we still have not yet seen any deterioration in the S&P 500. A lot of that has to do with low interest rates. Because interest rates are so low, investors are being basically forced into equity markets and driving prices to what we think are somewhat unrealistic levels. So at this point in time, we're being doubly cautious with equity markets. And just to push that point a little further, not just in the United States, but on a global scale. We look at the Japanese market, we look at Germany as a proxy for most of Europe, and we can look at what's been going on in China as well. So a lot of these markets pushing new highs. Very interesting. Something that Paul actually brought up earlier when we were chatting was, so what are we doing for clients as we see these pretty expensive equity markets? And one of the things that we are doing as we review and rebuild our portfolio models to try and bring down the costs, there's going to be some adjustments, gradual adjustments to some of the portfolios that clients have. And those adjustments will come. We'll look for opportunities with prices as high to sell some of the assets that we do own, and maybe be a bit patient replacing them with some of the assets that we want to own. Continuing to keep the models very much in line with what we talked about, but with some of these ETFs that we do own, we want to make some adjustments to lower cost ETFs. We might use some of these opportunities to lighten up a little bit on things that are right now we think are overvalued, and maybe be a bit patient to wait for value to get a little bit better before we replace them.
And Scott, I would just add as well that we have done a bit more due diligence and research on Equitable Bank, and we'll be using their high-interest savings account to effectively park some of our money, which is paying us 1.7% in the interim until we find more relative value in the marketplace. Yeah,
and clients who have been familiar with what we've done in the past, we've used Manulife, but Manulife lowered their rates when the Bank of Canada lowered its rates. So we have been looking for a better option for cash balances, and Paul's done a lot of due diligence and has determined that the Equitable Bank, similar to what Manulife was offering, but the Equitable Bank fund is a higher paying fund, and we want to take advantage of that. Paul, did you have anything else to add?
No, I'm good there. Thank you.
Okay, so basically that's our thoughts currently on the markets. We continue to monitor things on a daily basis. Tomorrow the Bank of Canada is going to release a quarterly monetary policy review. We'll be looking at that very closely for some hints of what we expect to see from the Bank of Canada in the short run and what their view is of the Canadian economy. We've been monitoring the U.S. Federal Reserve very closely. If you've been following my blog, I have been making my comments, but obviously the U.S. Federal Reserve is reluctant at the moment to really engage in normalizing policy and starting to push interest rates higher, because there's some concern about how the U.S. economy is what's happening to its growth with the advent of a very strong U.S. dollar. In essence, a strong U.S. dollar means that monetary policy is actually being tightened without the Federal Reserve raising its interest rates. So I think they're going to be monitoring that situation very carefully, as well as all central banks on a global scale are monitoring deflationary pressures, and certainly we don't want, or the Federal Reserve in the U.S. does not want to add any further deflationary pressures with raising interest rates in advance of when they should.
Hey Scott, I was just going to add as well, and we look at this, every hour of every day. But again, the government bond market, which we said in our slide presentation there, lead all financial markets. I mean, we are now going on, well, certainly last year was a bit of a shocker to most people, not us, but we're going on another year plus of the government bond market rallying rather strongly. So government bonds outperforming most, or certainly doing very well. I wouldn't say they're outperforming most other asset classes, but the bond market has been telling us something for quite a period of time, and it continues to do so. We need to pay attention to it. So that bond market is telling us something, and that the thing it may be telling us is that we are could be moving into a very deflationary global environment, and why stocks, as we still see on your screen, are at their all-time peaks. It's kind of looking a bit absurd right now.
All right. Well, thanks, Paul. And I just want to say thank you to everybody who's joined us this afternoon. Again, we'll be doing this on a weekly basis, so I encourage clients and others who have questions to feel comfortable in emailing us in advance if they wish, and we'll address questions on a regular basis as well. it's always important for us to understand how clients are thinking and what they're thinking, so that we can communicate back to them and address those thoughts and questions. So thanks again for joining us. Look forward to next week's. Probably won't be quite as long-winded, but if anybody would like a copy of the slideshow that explains our High Rock fundamental position, we are more than happy to send it out to you. So just send us an email or let us know if you'd like to receive that. In any event, thanks so much for attending, and we'll look forward to chatting again next week. Take care. Have a great week.